The artificial intelligence economy is going to be paid on-chain. The real on-chain payment flow already hit roughly $390 billion last year, and business-to-business payments grew more than 700%. The money is moving. So here's the trillion-dollar question almost no one answers right. Who keeps the toll? There are two confident answers, and both are half wrong. The traditional finance camp says show me the cash flows and misses that crypto tokens aren't valued on fees at all. The crypto camp says the token always captures it, a thesis that has quietly failed for a decade. The truth is a split between the token, the issuer, and the identity layer on top, and the edge is being the one who can see where the value actually lands. This is the asymmetric. The agent economy. Number 2, the toll, tech and crypto investing for thoughtful retail from an operator's lens. In our first issue, The Mirage, we showed the on-chain agents pay agents boom is mostly ghost volume. This issue answers the question that actually decides who wins. When the artificial intelligence economy's payments move on-chain, and they are moving, who captures the value? Here's the one-line read. The toll is up for grabs. The transport of value is solved. Blockchain moves money instantly, globally, and nearly for free. The open question isn't whether the artificial intelligence economy gets paid on-chain. It's where the value accrues. Two camps get it wrong in opposite directions, and the real map is two different vehicles, valued two different ways, with stablecoin payments splitting the value between them. We don't pre-call the winner. We built a scoreboard to track it. You'll see the same labels throughout. Confidence, high, medium, or low. Consensus versus variant, what the market believes and where we differ, and what would change our mind. This is a fast-moving, poorly measured space, so every figure is stamped. Part 1, the demand is real, and it's moving on-chain. The transport problem is solved. Start with demand and read it as a sequence, not a snapshot. Today, the buyer is a human or a business paying for artificial intelligence services, and those services want to get paid with low fees, instant settlement, and no cross-border friction. Next comes delegation. People hand agents a wallet and spend authority, and money moves into agents' hands. And the trend that follows is agent to agent, the mature state of the same flow, the destination, not a dead end. One discipline, today's agent-to-agent volume is about 80% wash trading, but the coming flow is real. Today fake, trajectory real. Now judge the size on the real flow, not the headline. Of roughly $35 trillion of stablecoin volume last year, only about 1%, around $390 billion, was genuine real-world payments. Business-to-business is the product-market fit, about $226 billion, up more than 700% year-on-year. And it's live, not theoretical. Stripe accepts stablecoins in 70-plus countries at about 1.5%, versus 3 to 4.5% on international cards. Meta pays creators in stablecoins, SpaceX runs treasury on them, and Visa is settling billions. The contest is no longer whether value moves on-chain, it's who keeps the toll. And we didn't just read about it, we ran a payment through the rails ourselves. We built a paying artificial intelligence agent on the base network. A request came back with the payment required response. The agent paid 1/10 of a cent in USDC gasless, the network covered the fee, and the data was released, with settlement confirmed on-chain. The transport layer is genuinely excellent. The friction wasn't the rail, it was funding the agent in the first place. And failure modes that are silent instead of clear. The rails work, demand is real, half of the thesis is verified by the data and by our own hands. Part 2, so who gets paid? The trillion-dollar question almost no one answers right. Here's where the analysis usually breaks, two confident answers, both half wrong. The traditional finance answer values everything on fee capture and concludes most crypto is worthless. It misses that crypto tokens aren't valued on fees at all. Bitcoin captures 0 fees and is worth well over $1 trillion. The crypto-native answer, the FAT protocol's thesis, says the protocol token always captures the value. That's half right for the wrong reason. Tokens did capture value, but through monetary premium and liquidity, not fees. A collapse in Ethereum's fees did not collapse Ether's value because Ether was never priced on fees. So the real map is two vehicles, valued two different ways. Tokens, Bitcoin, Ether, Solana are monetary and liquidity assets. Their value comes from adoption, monetary premium, collateral role, and speculation, all riding global liquidity. A discounted cash flow model is the wrong tool. Equities, Circle, Coinbase, Visa, Mastercard are companies with earnings valued on cash flow. That's the only layer where show me the cash flows actually fits. Don't confuse them. Size tokens for the liquidity regime value companies on earnings. For stablecoin payments specifically, the value splits across three claimants. The float, the interest on the dollars backing the stablecoin, goes to the issuer's equity. Circle is a $20 billion company built almost entirely on that. Settlement and liquidity dominance go to the winning chain's token, Solana, Base, or Ethereum, through network effect, even on thin fees. And trust, experience, and identity go to the layer on top. The weighting across all three is the open question. Part 3. What decides the split? 3 contests determine where the toll lands. First, open versus closed. Stripe is going proprietary, its own chain, wallets, and rails, to keep its margin. But walled gardens reintroduce the friction the technology removed and get routed around once money is native on-chain. Value migrates to whoever owns the neutral standard and the experience. Second, the death of ramp friction. Banks are moving money on-chain as tokenized deposits, and money is increasingly born on-chain payroll grants. Emerging market savings. The more activity that originates and stays on-chain, the more the ramp tax vanishes. Third, and the keystone, identity. Proof of human and proof of agent are 2 halves of one layer, the most underpriced and most defensible claimant, because it gets more valuable as money goes on-chain and agents multiply at once. So how would we express it or avoid it? The pure-play stablecoin stock is the most demanding way. Circle is a real bet on stablecoin adoption, but at nearly 100 times forward earnings, you're stacking 3 bets: that adoption isn't already priced, that its cut of the float survives competition, and that interest rates don't gut near-term earnings. Right thesis, steep price. The cleaner expressions are the toll booths that absorb stablecoins, Visa and Mastercard, which keep the consumer, credit, and dispute leg, or the float on a washout through Coinbase. Own the winning chain's token only as liquidity beta, not cash flow. And for builders, don't build the rail. If the open path wins, the build window opens one layer up. So where does it land? 3 things. Being paid on-chain is close to inevitable for the flows that matter, and we verified the rails with a real payment. The debate is magnitude and timing, not direction. Who gets paid is genuinely open, not the token, not only cash flows, but a split between the issuer's equity, the winning chain's token, and the layer on top. And the discipline, own the absorbers, don't pay a growth multiple for a rate-exposed bet. And use the right lens for each instrument. We don't pre-call the winner, we keep score. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.